Let's talk about Bank of India in greater detail and what the recent RBI policy means for the company as well as the outlook on the margins and asset quality. Vijay Lakshmi Iyer, Chairman and Managing Director, now joins in on the show. Thanks very much for being with us, Ms. Iyer. Let's talk about the RBI's policy move of cutting the MSF by 75 basis points and what exactly this would mean for your margins, given that your blended margins last time around stood at 2.5%.
Yes, so the RBI has recently reduced the MSF rate. This will definitely reduce the cost of funds for the banking industry as such. But Bank of India as such has not been borrowing under MSF window substantially. It has been quite minimal. And we are quite confident that we'll be able to maintain our margin as we had during the June quarter. Our global margin was 2.50, whereas our domestic margin was 3.07. And I am pretty confident that we should be able to maintain the same level of margin this quarter too.
Interesting. And Ms. Iyer, let's talk about your high exposure to the infrastructure sector. We've been discussing this with quite a few banking companies, and it seems like that seems to be one of the major concerns. Can you tell us as of now what your total exposure is and what is kind of NPA in the sector?
See, our infrastructure exposure is around 27% of our loan book. It has remained thus at the same level more or less last 3-4 years because infrastructure has offered really very good opportunities for the entire banking segment. And as you are aware, India is infrastructure deficient and we need to invest more in the infrastructure part of it. Coming to the NPA level, which you are very specific about it, we have not seen any incremental significant stresses in the infrastructure sector this quarter. So pretty much it is contained. Of course, a few sectors which have already got restructured, all of us are aware about it. So this quarter, I don't see any incremental either on the restructured portfolio or on the NPA level on account of the infrastructure segment.
So, Ms. Iyer, leaving aside the infrastructure segment, for a business as a whole, do you think that banks in general and you in particular will able to maintain on a quarter-on-quarter basis the kind of NPAs that you had shown, or will they show a worsening trend?
I will talk only with regard to my bank.
Sure.
We'll be able to maintain the infrastructure stresses at the current levels. And as you are aware, there is a standing committee which has been set up under the Prime Minister. We have been able to sort out quite a few stalled projects, and all of them are started, picking up the threads, and they would be completing their projects quite shortly, and they will in turn start generating the revenues. So I'm pretty sure that this should not cause much stresses for the bank.
Okay, the other bit is the belief amongst a lot of, including what the RBI governor said, and a belief amongst a lot of market watchers is also that because of the fact that the MSF has been reduced, the near-term liquidity and funding issues for banks and NBFCs in particular go away despite the repo rate hike. Now, is that a correct assessment, or do you believe that because of the RBI action, the liquidity will actually get constrained?
The liquidity is under strain even now. The MSF rate, of course, would reduce the cost of funds, and the reduction suggested by the Reserve Bank of India on the CRR maintenance would in fact slightly ease out the liquidity position. But nonetheless, as of now, liquidity is tight, and I don't think NBFCs are also experiencing in fact slightly strain on them, and we have witnessed quite a few of them approaching the banks for increasing the limits. But coming to Bank of India in particular about the liquidity position, we were successful in garnering a high amount of deposit during the first quarter, and that has in fact held us in very good stead during the current quarter. Though our deposit growth has not been there much during the current quarter, we have been able to maintain our liquidity profile, and we are not largely the lenders in the MSF segment. We do, of course, borrow to some extent under the CBLO.
Ms. Iyer, do you think that post the RBI policy now you will be compelled to hike your deposit and base rates? Is that something that you're looking at?
See, we have rolled back our base rate to 10.25 about 2 weeks back. I don't think there is any case for the bank to consider further hike in the base rate as of now. We are also not examining any hike in the deposit rate as of now because the bank has been able to hold itself quite well as of now. And though of course going forward, if the liquidity position will continue to be tight, we may have to look into hiking the deposit rate to take care of our margins. But as of now, we are not examining either increasing the deposit rate or on the lending rate.
Apart from that, could you also tell us about your credit as well as deposit growth, because your deposit growth stood at close to 22%, credit growth at 17% last quarter. Do you think that you can maintain these levels or even surpass it?
See, YOY, the growth in deposit and advances is quite impressive. But if you talk of this current quarter, our deposit growth has not been there, whereas our credit growth has been there around 5%. So YOY, of course, we'll be able to maintain these levels, not an issue. But the credit growth will be slightly more than the deposit growth, YOY basis. We are able to maintain that.
Ms. Iyer, you probably dwelled upon it just very briefly at the start of the interaction, but how do you expect the net interest margins to shape up for you as a bank in the quarter that is just getting completed, and also for the rest of the year? Would there be pressure, or do you think that banks in general will be able to manage it?
It depends upon every individual bank's assets and liability profile, you know, whether you are very much dependent on the short-term end or on the long-term end. If you are going to be very highly negative on the short-term end, such banks will have to go to the market for borrowings and for raising the high-cost deposit, which is not the case with Bank of India. We are quite comfortably placed as of now, and I don't expect my margin to come under pressure for the current quarter. I will be able to maintain as we did as of June quarter.
You are saying, I'm gathering from your answers, and correct me if I'm wrong, but you are saying that for you, there is not too much of a liquidity constraint. For you, for the next 6 months, you will not have to resort to high-cost deposit fundraising to meet any kind of credit growth
No, I
figures.
didn't mean that. I didn't mean that. I said as of now we never had to approach the market for raising the high cost deposit or take the borrowings under MSF window. That is primarily because our deposit growth during the first quarter was very high. Going forward, if the liquidity is going to remain tight, which I'm sure it will pretty much ease out once the FCNRB funds also come to the market, liquidity position should certainly ease out. So, I mean, I'm only talking of the current quarter, not of the immediate next 6 quarters. It all depends upon how the liquidity will pan out, how much more we are able to garner under the FCNRB front, because we are able to swap it, and that money will come, of course, will increase the liquidity in the Indian market too.
That was going to be my next question, Ms. Iyer. Have you taken advantage of the FCNR swaps?
Yeah.
What's the kind of deposits that you've been able to garner under this?
Yeah, certainly given the good overseas presence, we are also taking advantage of that. I don't have the immediate figures as of now, but easily I think we should have mopped up around 500 to 600 million so far. This is my rough estimate. For this month, we should be able to do that.
For the month. Do you expect that window to be
for
sizable?
September end, yes.
Yeah, and do you expect that window to be sizable?
Yes. Yeah, this is open for the next 2 months also. So this window also would definitely help us to garner and increase our growth there. At least up to 1 billion to 1.2 billion overall.
Okay.
Iyer, could you talk about what is your foreign currency exposure right now, and what kind of risk do you see to your overall profitability on account of the way the rupee has been behaving?
Foreign currency exposure we are monitoring very, very tightly. No doubt such of the companies who have not hedged, generally all the borrowings which we do, all the lendings which we do, we generally insist for the hedging also simultaneously. But of course you cannot expect a company to hedge 100%. And we have increased our exposure in the last 2 quarters only to well-established multinationals who have got very good risk management practices. And we do have the current exposures we monitor on a daily basis. I don't think there is going to be any significant hit for the bank from this portfolio. We'll be able to contain the forex risk substantially.
Just one final word, Ms. Ramanathan. I mean, you would have heard about the government announcing the second half borrowing program as well, Ms. Iyer. How do you see the demand for the government borrowing program?
Yes, going by the last 2, episodes, of course. That is primarily because of the interest rate also, of course, the yield rising it, and the lack of liquidity in the market. Going forward, the government has maintained that it will contain at the earlier level only what they had indicated, around $2.35 trillion, and that should go well, because there should be easing of liquidity at least in the next month or couple of months. It all, of course, parallelly will depend upon how US tapering also will happen. Whether if it happens during the current year, then maybe we'll have to see the pace of it, the speed of it, and that might to some extent affect. But I don't think the government borrowing should have any issue in the context. The money should flow to the emerging markets where the interest rates arbitrage is available, and we need to keep that in mind, and accordingly, of course, RBI will take care of it, certainly, which they have been doing.